Hello, investor. This is the seventh episode of Dara podcast. I'm your host, Dara. In this episode, we will discuss one of the topic I would say it's kind of fundamental in finance, which is financial statement, right? I would say I would try to, give you what it is, what I think is important about the statement, and how investor actually can look at it, assess company. And yeah, lastly, I would try to give you some key comment I would think really important for those that actually analyze financial statement. Okay, so firstly, the definition of financial statement, let's talk about that first. Well, if you ever heard of the term financial statement, it's actually like a report that showcase the financial health of a company, but also what it is standing right now, right? Financial statement divided into five, but the last one is not really a statement, but we call it as well, right? So there's statement of profit loss, balance sheet or statement of financial position, statement of cash flow, statement of changes in equity, and last one is notes. Okay, now for statement of profit and loss, it mainly focuses on the performance of a company, a performance of a business, mainly into whether the company, the business actually made profit and loss, right? And it gives us the view of what are the income, what are the expense, giving us the margin, the gross profit margin, the net margin as well. I will also try to talk a bit into ratios, right? To give you that glimpse of idea because it's really important. Another thing is that usually investors look at, the statement of the profit and loss. They try to look into the production costs, whether this year, last year, there are more production costs than the last year, something like that. And revenue is also a good, I would say, start when you look at business, whether it's doing great or it's doing worse. If the sales or revenue go down, that means that it's actually doing bad, right? And the opposite applied. And so yeah, that's pretty much it about profit and loss. I would say that most of investors, they do look at the statement of the profit and loss. However, they actually start to look into cash flow and balance sheet. Balance sheet or statement of financial position is really important. Okay, now let's go to statement of financial position, right? For this statement is actually focused on the position that the company or business standing right now. So why it named financial position and why the statement of profit and loss actually named like that, right? As I said earlier, statement of profit and loss, it would focus on the performance of the company. Financial position, it indicates the key measurements. So example like the cash, asset, liability, equity, that those are the main component in the statement of financial position. And so this is like an accountant 101. Is like a company can have their asset and also their liability part. We can say it as asset and liability management as well, because it's really important, right? If you want to create an asset, you need to invest it. right? To create the asset to make it grows, okay? And some company, they can't just keep adding equity, right? They need to use some sort of finance, and this we call it into the liability part, which the company inject money using creditor money, right? Not their own money. And so we call this like a debt finance, right? And in the statement is how we look into what is the debt value that company is holding, right? Whether they have a lot of debt, a lot of liabilities, something like that. And we can also measure the debt, compared by the asset, the total asset of the company, debt to asset ratio, the debt to equity, and also the debt to capital as well. Capital refers to debt plus equity, right, into one sum. And it's really important. A lot of investors actually look into this because it actually point out what the company is standing right now. One more thing I want to add is that the statement, right, the timeline, we talk about the timeline for statement of profit and loss. We covered the duration, right, during the start and the end of the year, right? We cover only in the middle, okay? It's trying to tell us how much a company create value, made profit within measure of years, okay? For financial position, it's much different. It actually focus only one specific at one specific date. So example, we talk about 2024 to 2025. If you look at statement of profit and loss, we cover the duration between the year, right? Between 2024. And if you look at balance sheet or the statement of financial position, we actually look at the end of maybe 2024, what is the position of the company, or 2025, what is the position of the company. So that is the difference of how the statement actually works, okay? Another one is how connective it is. So for statement of financial position, if we look at the cash, for the cash, it comes from the, I would say, what the company is having in their bank account on hand, right? And one more thing I want to add is that if you look at the retained earnings, this also relates to dividends, okay? Now, in a statement of position, one of the interesting things we lies in the dividend, right? When company don't pay dividend, you don't need to care about that. But when they do, statement of financial position have something called retained earning, and retained earning basically means after you have your profit from the statement of profit and loss, you minus the dividend, right? You take out the dividend. How does it work? Well, it means that when you have profit, when you have money at the end of the year, you give out to your shareholder. The shareholder get money, you pay them, right, as a dividend. So the money that left after paying out those dividends, we call it as retained earning, and it is recorded in the balance sheet, right? So it's a bit interesting in those key areas, okay? Now, let's look at statement of, I want to get into changes in equity first, before we get into statement of cash flow, because that cash flow is really, really important. For statement of changes in equity, it mainly focus on the fund or capital of company during the period and start and ending as well. So example, at the start of 2024, company A, they have around 1,000 fund, and so what is the profit that they made in 2024? Example, they made 500, so 1,000 plus 500, that 1,500. But then example, okay, they pay out dividend for another 500, so it's actually 1,000, right? So 1,000 plus 500 minus 500, so it's 1,000. And you know, there's a lot of component into this, so you can add profit, you can minus dividend, you can also do foreign exchange as well. Foreign exchange means that when you record, so when you actually sell something or you purchase something, you record, right? You record in your accounting system. But let's say you don't want to pay right now, right? During the recording the account, the double entry, right? You just want to pay, example, a month later, 2 months later, or a year later. What this does is that the exchange rate of the exchange rate of currency of the transaction will change, right? So example, I give you example between USD and Chinese yen. For this two example, you actually buy a computer from China using USD, right? And you not yet actually pay out those money yet. You just record it, and so you want to pay out a month later. And so when you actually pay out, example, the computer price is $100. When you record it is $100, right? For 100, example, 200 yen, something like that. But then when a month later comes and you pay out, the rate changes. Example, 200 yen requires $150. That's just an example, okay, for clarification. So that's mean you made $50 loss, right? You can just pay it when you record, but you decide not to. You decided to pay later than the date that you recorded. Okay, so you made a loss. So that also impact in the statement of financial position as well, right? Really interesting. And also the I said wrong. It affect the statement of profit and loss, which refer to other comprehensive income, and also the statement of changes in equities, right? So there's a lot of fun that can impact and influence the capital of the company, and so we need to deduct, we need to add some, all the calculation before giving the result of the ending capital. So it's how we record the system, right? And lastly, I want to talk about statement of cash flow. Now this is really important. For statement of cash flow, we look into 3 activities of a company. We're looking at operating, investing, and financing. Okay? Now, cash flow also divided into other 2 types. Mainly, we call it as FFCF, or free cash flow to firm, right? And FCFE, free cash flow to equities. What are the different? Firstly, let me explain you into the activities first, right? Before I explain you into those two big types. For the activities, first one, operation. This means that we consider all of the cash flow comes from our operation, our business, right? Now, here's where the tricky part comes to play. Accountant can record the statement of cash flow in the operation section using two methods, and they can use either one. So there are the direct and indirect method. What are the difference? Well, the difference is that if you are an accountant, you have the direct, I would say, direct income and direct expense of a company, then it's easy. You just take the income as cash inflow and the expense as cash outflow. You can calculate for the statement of cash flow in the operation cash flow section. However, for indirect method, this applies to when the accountant don't know the direct earnings, direct cash flow, or direct outflow. So they relies on what we call the accrual method turned into cash method. What this means is that, let me explain you a bit about working capital, okay? Because I don't think I talked about it yet. For working capital, it refers to the fund needed for the company to stay alive, to get the money and then pay for their suppliers, right? And in the indirect method for operating cash flow is really important, right? Why? Well, working capital focuses on three components: the receivable, the inventory, and the payable, right? So two assets and one liability. Now, indirect methods say that if the receivable and inventory decrease, we count it as cash inflow. If there is a increase of payable, we call it as cash inflow as well. However, it is opposite, meaning that the company will call it as cash outflow if and only if the receivable and inventory will increase and the payable will decrease. Now, why is this? Let me explain to you, because this is really important. For now, like I said before, it turned the accrual into cash basis. For indirect method, we work with receivable, inventory, and payable. So when receivable and inventory, remember, all of these three components is in accrual mode, right? What does this mean? Well, for receivable, it means that you don't receive the money, but you record it. Inventory, you don't pay for manufacturing your products yet, but you record the cost that will incur for manufacturing your products, right? Which is the inventory. And for payable is similar things. You don't pay out your supplier yet, but you will record what are the amounts that you will pay. Okay, so it's in accrual basis. And the working capital indirect method, they say that if the receivable go down, which means that customer actually pay us, right? That's why the receivable go down. And so there's a cash inflow. Inventory is the same thing. When there's inventory decrease, right, it goes down, what does this mean? We sell products, we get money, we earn money. So there's a operating cash inflow. How about payable? For payable, this is a bit interesting, because payable is a liability we pay out, but why there's a cash inflow? Well, when you increase the liability, when you increase the payable, which means that you don't have, it means that you will delay, you will extend the credit term for your business to the supplier, right? Which means that you don't have to pay them right now. You can delay, okay? And this means that there would be no cash flow, at least not in the moment right now. And it means that there are no cash outflow, there's cash inflow, right? That's why when the payable increase, people don't have to pay it right now, business don't have to pay it right now, it means that there's a cash inflow, right? Because there's no cash outflow, okay? The same thing applies to if there's an opposite direction, okay? Now that is for operating method, okay? And for working capital, receivable and inventory and payable, those are the subsets. Those are the main important component, similar to revenue and expense, right? Those are the closest subsets. Yeah. Another activity, we will move to the investing, right? The investing cash flow. Now for investing cash flow, we refer to what the company invests into, right? Well, you may ask, okay, investing, you mean like, they buy stocks, they buy bonds, they invest in securities, something like that. Well, technically, yes, but also no. We do record investing in stocks as in the investing activities, only if it is in the long term, right? In the short term, we include it in the operating section. But the whole idea is related with CAPEX, right? CAPEX. So CAPEX refers to the word capital expenditure or capital investment. It means we refer to the purchase of machine, of equipment, all of any, I would say, long-term asset. So the company need to record that as well, right? Example, if a company want to buy equipment, want to buy machine, it counted as cash outflow. Investment also counted as cash outflow, right? However, if you decide to sell a machine and equipment, then that's the cash inflow. So that is the main idea for investing activities, right? And lastly, I want to go to financing cash flow before explaining you into free cash flow to firm and free cash flow to equities. Now, for financing cash flow, we focus mainly into how the company finance, which, if you remember, I talk about loan or equities, capital injection that the company may take, right? May make. So, if the company get more loan, then there will be a cash inflow. If the company get more capital, then there's a cash inflow. If the company decided to go IPO, increase their capital stocks, or make a, I would say, direct pricing, giving out private loans, all of those things. So when there is a loan, the company get the loan, there's a cash inflow, right? If the company pay out loans or pay out the debt, then there's a cash outflow. Same thing with capital. If the company issue more capital, issue more stocks, then there will be a cash inflow because the company can actually gain more stock price, stock capital, the funds, right? However, opposite applied if those funds pay out dividend, because stockholder that invest in the company, they will get dividends, and the company needs to pay dividends, there will be a cash outflows, right? Yeah, those are the components. And one more thing I would like to tell you is that related to interest payment and interest earned. Interest payment refer to the interest of loan that the company actually need to pay to their creditor. So this is a cash outflow, and we mostly record it in financing cash flow. If the company earn interest, which means that they investing in the company, they earn the interest for any reasons, then it's just not it's not just investing in companies, but any activities that they can earn interest, then it is a cash inflow, and we mostly record it in the investing section. Okay, now those are the things I would like to clear with you for all of the cash flow statement, right? Now, what is free cash flow to firm? What is free cash flow to equity? I probably will talk about this in my other video, but let's see. Free cash flow refer to the cash flow that the company can pay up to both the investor and the creditor. Okay? For free cash flow to equity refers to cash flow that the company can offer to the investor after they pay all of their debt to the creditor. Okay? Those are the two things. For free cash flow to firm, we focus on taking the operating cash flow and then deducting the cash flow from investing activities. So example, you made $1,000 from operation, right? Operation cash flow, but then you decided to invest or you decided to buy equipment or buy machinery. So that's mean that the cash that you have remains after that, it will be considered to give it to the investor and for the funds as well. Okay, for the free cash flow to equities, we take all of the cash flow that we calculate, right? So operating cash flow minus the capex, investing activities minus the financing cash flow, right? We will have the cash flow that can give to the investor. Okay, because why? If you look at it, the free cash flow to firm, we deduct the capex, but we don't deduct any finance, right? So we deduct only capex, and then those are the funds that we have available for investors and the creditors. For free cash flow to equities, it refers to the equities or the cash flows that remains after paying the debtors, the creditors, right? And so, yeah, those money go to the free cash flow to equities. Those are the importance, and I would say, people and especially investor, financial analysts should focus into how this number interact one another. For ratios, in profit and loss statement, we focus in the profitability ratio, like the gross profit ratio, the operating profit ratios, the net profit margin ratio. Okay, we focus on how the company actually made profit per sale. Okay, and then for balance sheet or free cash flow, not free cash flow, but the statement of financial position, the ratio we focus on, I would say a lot, but let me list it down. So we look into the current the cash ratio, which assess how the company have in their asset, how much their asset right now in their bank account to pay off their current liabilities. Okay, only current liabilities. Another ratio called solvency ratio. This ratios focus on how the company will pay out their long-term debt. Okay, so the asset to long-term debt. Another ratio will be working capital. So working capital days, example, receivable days, inventory days, payable days. The formula is working capital equal to receivable plus inventory minus payable. For if you convert it into days, into length, we call it as cash conversion cycle, which refers to the days the company takes to earn the money from the customer or actually selling their products, and also to pay out their supplier as well. So if the cash conversion cycle is very, very long, or there's a big number, this means that the company needs a lot of money and need long time to get money from customer and pay out their to the suppliers, right? Another ratio in balance sheet referred to gearing ratio. This referred to how much the company has for its debt, equivalent to their equity, their capital, trying to assessing what is the how much debt the company actually acquire. For the statement of changes in equity, there are no ratio, except I believe would be yield, would be dividends, some sort of things like that, capital. For free cash flow, there are also no ratio. However, we try to focus on valuation, right? Free cash flow is important for valuation. We're trying to assess the real value of a company, of an asset, right? And how we do it? Well, we try to assess the equity value, which is the value of the company, like I said earlier, using the information of the cash flow. But if we do valuation, we try to compare, we try to look out what are the cash flow from the future of the company and assess now. So we basically say, okay, I have the cash flow in the future, and I'm trying to assess whether those cash flow will reflect the true value of the company right now. So example, if the company have a good free cash flow in the future, then the value of the company right now should be good and you should buy. However, if it's bad, then you shouldn't, right? But it's not easy just to assess something like that. We need a lot of calculation, a lot of analysis, a lot of things to make our projection, our analysis complete. Okay, but yeah, that's the whole story of financial statement. Investors try to assess what's going on into the company, and they give out recommendation, trying to assess the performance, position, cash flow, and capital funds as well, right? So yeah, I hope you learned something from this podcast into finance, into the component of financial statement. Oh, and one more thing related to notes. It basically give us more information of how each account in the financial statement are calculated. So example, revenue, it will state it how the revenue is actually calculated. There are different revenue source, and those revenue sources come to one. So notes basically tell more detail into how financial statements actually goes. All right, it's really important as well to look at the notes to actually assess more, and we can't just look into numbers, right? We also need to look into accounts as well. It's really, really important. Yeah, I believe you learned something from this video, And if you have any question, concerns, feel free to comment down below. I will read it. I will reach out to you. And yeah, if you have any comments or topic you want me to talk about next, feel free to let me know. All right. Other than that, thank you everyone for watching this episode of Dara podcast, and I will see you in the next episode. Thank you.